Welcome to the lecture on problem solving on tax analysis. So, in this lecture we are going to solve the problem based on the tax calculations and the associated changes in the cash flow diagrams. So, we are going to discuss about a problem in which the asset is said to be purchased for rupees 20 lakhs with estimated life of 5 years, salvage value at the end of its life as 0. So, you are taking the first cost of the asset as 20 lakhs and life is 5 years. Then gross income produced is rupees 7 lakh every year. So, income every year is rupees 7 lakhs. Effective tax rate is 30%. And the internal rate of return, interest rate is given as 12%. So, basically we have to find the present worth of income taxes for the three methods. The three methods are straight line method, double declining balance method switching to straight line, and sum of years digit method. So, with the three methods we will calculate the income taxes and associated cash flows, and based on that we will have the present worth values of the income tax values, and then we will try to compare them. So, let us see if we have the straight line method, the equipment will have the cash flow before tax will be like this. You have end of year and before tax cash flow, you have depreciation so in the 0 year you are having 20 lakhs of the first cost, first, second, third, fourth and fifth year you are having an income. So, this is minus and income is 7 lakh every year. Now, if you look towards the depreciation charges, being the 5-year property, the depreciation amount every year will be 4 lakhs. So, taxable income we can have, because these depreciation charges will be deducted from the income. So, it will be 3 lakh then after tax cash flows we can calculate. So, in the after tax cash flows, you will have 20 lakhs in the beginning, that is minus value, and then you will have the, before that basically we have to compute the tax. So, we have to compute the tax. Effective tax rate is 30%. So, it is 90,000 in every case. Then in the end you have after tax cash flows. So, you have this much as the tax, basically not on the 7 lakh, but basically you are giving the tax on 3 lakh. So, that is coming as 90,000. So, after tax cash flows comes out to be, you have minus 20 lakh, then this will be 2,10,000, so this is how the after tax cash flow will look like. Yeah, one modification is there. Basically we have this amount as the tax. So, after tax we have the income as the before tax income minus this tax. So, this will be 6,01,000. In every case it will be 6,01,000 instead of 2,01,000. You have 6,01,000. So, this is how your after tax cash flows will look like using a straight line method. Now, let us see for the SOYD method. In the SOYD method, again we will have the same table, end of year, before tax cash flow, and we have depreciation, we have taxable income, we have income tax, and after tax cash flow. So, in the first year, now let us see our, this is 0. So, we have minus of 20 lakhs, and then for the 5 years we have income as 7 lakh, so 7 lakh is the income every year. Now, in the case of SOYD, we know that the depreciation during the first year will be 5 upon sum of years digits. So, sum of years digit is basically nothing but 5 into 6 by 2. So, it is 15. So, 5 by 15 into 20 lakhs. So, it will be 6667. 6,66,667. Then next time it will be 4 by 15 into 20 lakhs. So, it is 80 lakhs divided by 15, it will be 533,333. Then next will be 3 by 15 into 20 lakhs. So, it will be 4 lakhs. Next will be 2 by 15 into 20 lakhs. So, it will be 266667, and similarly in the end it will be 133333. So, this is how there will be change in the depreciation as compared to the straight line method. Now, taxable income will be basically the difference of the income and the depreciation charge. So, 7 lakh minus this amount, this is 33,333. Then in the second year minus 533, it will be 1,66,667. Then further 3 lakhs, and then minus 266,667, that is 4,33,333, and then it is 7 lakh minus 133,333 will be 566,667. So, this is how your taxable income will be calculated. Then you have to find the income tax. Income tax will be 30% is the effective tax rate. So, 30% of this amount. So, this will be basically equal to 10,000. This will be 50,000. This will be 90,000, and this will be 1,30,000, and this will be 1,70,000. Then after tax cash flow will be shown as minus 20 lakh, and now your income will be 7 lakh minus 10,000, so 6 lakh 90,000, 7 lakh minus 50,000, so 6 lakh 50,000. We have 7 lakh minus 90,000, so 6 lakh 10,000. We have 7 lakh minus 130,000, so 5 lakh 70,000, and this is 7 lakh minus 170,000, so 5 lakh 30,000. So, this is how the after tax cash flow will look like in the case of SOYD method. Now, let us see with the DDB switching to straight line. Now, in the case of DDB switching to straight line, we will have the table. So, in that again we have the before tax cash flow minus 20 lakh at 0 time and then 7 lakh as income every year. Then you have the depreciation. So, the depreciation in the first year, it will be basically, if you are using the double declining balance, the rate of depreciation is 1 by 5 into 2, so 40%. So, it will be 8 lakhs. Second time it will be 40% of 60, that is the book value, so 24%, and that will be 4,80,000. Further, in the third year, so if we take the DDB with switching, you have in the first year as 40%, second year as 24%, no switching, third year as 14.4%, fourth year as 10.8% and fifth year as 10.8%. That we had done earlier. So, you get 14.4% of 20 lakh. So, it will be 2,88,000. Further, it will be 2,16,000 and 2,16,000 during the last 2 years. Then, if we look at here, the taxable income is basically, what we see is, we have to get the tax benefit here in this case. So, you get minus of 1 lakh, and then in these cases you are getting 2,20,000, it will be 4,12,000, this will be 4,84,000 and 4,84,000. So, if you look at the income tax, in this case you will have income tax saving, and if you take the tax rate as 30%, unless there is certain percentage of it is being taken, if you take the same data, we have a tax saving of 30,000. Here it is 66,000. This is 1,23,600. This is 1,45,200. and 1,45,200. After tax cash flow, so this can be seen as minus of 20 lakh. Here it will increase by 730,000. You have 7 lakh minus 66,000, 6 lakh 34,000. You have 5 lakh 76,400, then 5 lakh 54,800 and 5 lakh 54,800. So this is how the depreciation schedule looks like. Now we have to see what is the present worth of the income tax which is paid. So if we calculate the present worth of the income taxes using the three methods, present worth of income tax using straight line. So what we get is, you are paying the tax of 90,000 every year. So at 0 time 90,000 will be multiplied with P by A, and rate of interest is 12%. So 12.5. P by A 12.5 can be seen here, and P by A 12.5 is coming out to be 3.605. So the amount of tax what you are paying, that is worth of 3.605 multiplied by 90,000, and this is 3,24,450 using the straight line method. If you go with SOYD, SOYD will be calculated. If you look at the taxes, there is 40,000 of increment every time. So we can have the annual equivalent value first of all for all that, or even we can get it all them as 10,000 multiplied by P by F 15.1, 12.1 plus 50,000 multiplied by P by F 12.2, 90,000 multiplied by P by F 12.3, 130,000 multiplied by P by F 12.4 plus 170,000 multiplied by P by F 12.5. So this can be done by using the geometrical gradient series, uniform gradient series basically. So it will be 10,000 plus 40,000 A by G 12.5, and once we get this will be multiplied. So this will be the equivalent annual series and its equivalent at the present time. For that you have to multiply by P by A 12.5. So A by G 12.5, A by G 12.5 is coming out to be 1.774. So it will be 40,000 multiplied by 1.774 plus 10,000 multiplied by P by A 12.5, that is 3.605. So it is coming out to be 2,91,000 861. So, in the case of straight line method, we have paid the present worth value of the income tax as 3,24,000. In case of SOYD, it is 2,91,861. Now, in the case of DDB, we see here we have minus of 30,000 multiplied by P by F 12,1 plus 66,000 multiplied by P by F 12,2 plus 123,600 multiplied by P by F 12,3 plus 145,200 multiplied by P by F 12,4 plus P by F 12,5. So, we have to calculate this. P by F 12,1 is P by F 12,1 is 0.893. So, 30,000 multiplied by 0.893, 26,790 plus 66,000 multiplied by P by F 12,2, that is 0.797, that is 52,602 plus 123,600 multiplied by P by F 12,3, 0.7712, that is 88,003 plus P by F 12,4 plus P by F 12,5. So, P by F 12,4 is 0.635 and this is 0.567. So, if we add them, it will be 1.2, so 0.635 plus 0.567, that is 1.202, multiplied by 145,200. So, it is 174,530. So, this will be added with 88,003, 52,602 minus 26,790. So, it is coming out to be 288,345. So, these are the three values of present worth of the income tax which is paid using these three methods of income taxes, I mean three methods of depreciations cited, and the resultant cash flow is also shown, and it is seen that using the double declining balance method switching to straight line, it gives you the minimum value of the present worth value of the income tax paid, followed by SOYD, and then the maximum is paid by the straight line methods. So, we can solve more questions based on the tax analysis, and our confidence will increase as we increase the number of questions solved. So, this is the end of this lecture, and this is also the end of the course. The last lecture has finished. I hope you have enjoyed. I feel that more and more you solve the problems based on this economic analysis, you will be having more and more confidence. I hope you also solve the tutorial and assignment questions, and maybe I am quite sure that you might have got a lot of confidence. So, I hope that you will do well. If you are appearing in the exam, do better, and best of luck for the exam if you are willing to get the certification for this course. Thank you very much.